15 days since the finance minister announced the revival of long-term capital gains tax, and tax experts are already scratching their heads on the implications of this tax on inherited shares, mergers, demergers, initial public offerings and more. The FAQs published by the Tax Department don't offer any clarity on these issues. The fine print spoke to experts on the unanswered questions on the long-term capital gains tax and their potential answers. Effective April 1st, 10% long-term capital gains tax will be applicable on gains made on the sale of listed equity shares exceeding 1 lakh rupees. The announcement was made by the finance minister in this year's budget. To the relief of investors, long-term capital gains on listed equity shares till January 31st this year have been grandfathered. That is, they won't be subject to tax. Soon after, the Tax Department issued a FAQ clarifying the methodology to calculate the gains, date from which the holding period will be counted, and more.
So I think that 4th February FAQ was a very interesting FAQ in the sense that it was fairly detailed. I think two things that stand out. One, that under various modes of facts, computation has actually been provided as to what is the intent of how the 31st January market value must be substituted, how that should not result in creation of a loss, but insofar as it takes your capital gains down to zero, it is still permitted. So that was one thing that I found interesting in the FAQ. I think the second important feature is that the government reiterated that the benefit of the June 2017 negative list will continue to be available for the purpose of 112A as well, this provision as well. And I think that was important for the government to state, because a number of situations could have arisen had those guidelines not been made equally applicable to the new dispensation. So for me, these are the two things that stand out in the Feb 4 FAQ.
Second aspect which I would like to highlight on the FAQs is there was sort of an ambiguity around the bonus shares and right shares, which have also got clarified through the FAQs, and I think that has also helped quite a bit.
But several questions remain unanswered. The first is whether mergers and demergers will get the benefit of the grandfathering provisions. Several ongoing transactions, for instance IDFC Bank and Capital First merger and IIFL's demerger, will run into this problem if the government doesn't clarify the position. As per the latest SEBI data, 22 schemes of arrangement are in the works. Take the example of a court-approved merger of Company A and B that becomes effective post-April 1st. Let's say the shares of Company A get cancelled and its shareholders get shares in Company B. Tax expert Amrisha explains that it's not clear if the shareholders of Company A will get the benefit of grandfathering provisions since they didn't hold shares in Company B as on January 31st, 2018.
Were these shares held by them as on January 31? When I say these shares means shares of Company B held by shareholders of erstwhile Company A on January 31, 2018, then the answer is clearly no. Therefore, would they get the protection of the fair market value as on January 31, 2018 is not coming clearly from the provisions as they are stated today. Would the government need to clarify that? Absolutely, the government will have to clarify that, because there is a different provision in the Income Tax Act which says that if you had to replace the actual cost, then the actual cost of Company A in my example, or the merging company, would be allowable to the shareholders of erstwhile Company A while determining the cost of Company B shares. But is there a similar provision for the fair market value replacement as on January 31, 2018? Then the answer is no as of now. So hopefully, I think a lot of representations are being made, and I feel that the government will clearly clarify, because I don't think the intention is to not provide for that benefit, especially in genuine cases of those mergers that may be happening.
In the case of a demerger, since you asked that specific question, the uncertainty arises from the fact that today I hold shares of one company. going forward, let's say the company is in the process of demerger, it will issue, once the demerger is completed, it will issue me shares of the resulting company as well. And if the question that will arise is, my today's value includes the value for the business that is being demerged into the resulting company, and in a sense therefore includes the value of the resulting company share as well in my 31st January quote. However, the way the law is worded, for the shares of the resulting company, since that company would perhaps not be listed as of January 31, for the shares of the resulting company, I will not get the benefit of restatement of my cost base to the 31st January fair market value, because none exists. And a similar situation arises in a merger scenario as well. This situation does not apply with the same force for those transactions where the underlying share remains the same. In a demerger, for example, while I retain the share of the demerging company, I'm issued a new security in the form of shares of the resulting company, which is why the problem.
Today also, companies which are going through demerger do provide a breakup of the proportion for cost purposes of what is the demerged company cost and what is going to be the resulting company cost of shares as required under income tax for the actual cost bifurcation purposes. The same ratio or the same aspect can be used to also split the fair market value, and this is done on the basis of book value of assets being split. It is not done on the basis of fair value of assets being split. That's the formula today that is already there in the Income Tax Act. So it's the question of just applying the same formula for fair market value.
Similar issue may also arise for convertible securities which were not held as shares as of January 31st, 2018 and are then converted and sold post April 1st. The issue gets equally complicated for shares inherited after January 31st, 2018. For instance, if X acquired shares in March 2002 and they were inherited by Y on February 15, 2018, it's not clear if Y will get the benefit of fair market value of these shares as on January 31st, 2018. In the absence of any clarification, the long-term capital gains will be calculated based on the fair market value in March 2002, since Y did not own the shares as of January 31st, 2018.
The person who has inherited those shares, as per the language today of the provision, is not entitled to the fair market value replacement as on January 31, 2018. So to that extent, you will go back to the cost because the Act provides for cost replacement. So the cost of acquisition in the hands of the parent will be considered as the basis if the shares were to be sold on or after April 1, 2018. So you will get a long-term capital gain asset benefit. So the period will be counted of the person who has died, and the cost will be counted. But fair market value, I think they need to come out with the guidance on that.
I don't quite agree that this provision is that unclear. What they've stated in the FAQ at a generic level is the benefits that were available in the 2017 notification that you just referenced in the context of Section 1038. They've said that notification will be reiterated in the context of this section as well. Now, if I were to take that statement at face value, that would mean that benefits that were available in respect of all the situations which were addressed by that notification would still continue to be available. Now, let us therefore go to the specific instance of inherited shares that you point out. In the case of inherited shares, if that benefit is, obviously at the time of inheritance no SCT is paid, but if that notification is extended for the purpose of this section as well, then the fact that SCT is not paid will not disentitle me from the 31st January step up. The other thing that I have to see is cost base should be the cost base that would have been available to the previous owner. For that, there is already a specific provision in the tax law. Period of holding should have been period that was available to the previous owner. For that, there's a specific enactment already existing in the Income Tax Act. The share or security should not have changed. Like in the case of a merger or demerger, why is the problem arising? Because the share or security changes. In the case of an inherited security, the share or security does not change. So all three conditions in a manner of speaking are satisfied. The share does not change, cost of acquisition is available, time period of previous owner is available, and fourthly, the government has clarified in the FAQ that the benefit of the June 2017 notification would be available. All that the government has not done is specified inherited shares by name right now in the FAQ. But I would sort of read that as implicit in the way the FAQ is drafted up, and I would expect there to be no real trouble in the context of inherited shares.
The final challenge will be for initial public offerings and follow-on public offers that are in the works. Companies hoping to make a debut on the stock exchanges post April 1st will face the long-term capital gains tax conundrum as well. Since such a company was not listed as of January 31st, 2018, long-term capital gains for sellers in these IPOs may be based on their original acquisition cost. As of February 9th, 18 initial public offers are under process, including that of the National Stock Exchange and Bandhan Bank.
Till March 31, 2018, what is going to happen is, if you are selling under an OFS thing, you were exempt from long-term capital gains because you used to pay an STT of 0.2%. Now, April 1 onwards, you are not likely to be exempt from long-term capital gains because of this new provision. The issue that arises is that should then these people pay the long-term capital gains linked to the actual cost price that they had incurred on acquiring the shares, or should they also be given the benefit of the fair market value replacement as of fair market value as of January 31, 2018 from a replacement perspective. And I think just to be fair, because this is people who have built the companies and they need to go to the next level, and therefore they are in the market for fundraising, and who have created several opportunities in terms of jobs and in terms of kicking the economy on. If you have to provide for that benefit, then one way to look at it is to say that the higher of the net asset value or the discounted cash flow as of January 31 of that company which is going to go into IPO needs to be considered, and that needs to be as one of the determinants of the cost of acquisition. So let's say if there is a promoter or a technocrat who has built the company and he's acquired the shares at par value when he had built it, let's say it's 10 years back, but the DCF value or the NAV value now, higher of the two, is 100 rupees, and he's coming out with an offer for sale and under an IPO at 130, then should he be taxed 130 minus his original cost of 10, or should he be taxed 130 minus 100, which is the replaced value as of January 31, 2018? And I think there is a fair ask as of now that it should be only on the 30, which is 130 minus 100, because then you equate that with listed stocks.
I think again the only problem cases are the cases there where IPO documents have already been filed with SEBI or tickets have been issued by SEBI, but listing has not occurred before 31st January. Going forward, in any case, if IPOs are to happen in future, it is very clear as to what the tax dispensation is. You buy shares in an IPO and you will pay the necessary tax. In respect of IPOs, FPOs that are in progress right now for an unlisted company, there some issue could arise on how the 31st January step-up should be calculated. In my mind, in the manner in which the law is currently worded, no such step-up will be available. But that is perhaps not entirely unfair also, because that share will effectively get listed only post the 31st January deadline. Now the only dichotomy is, when I would have filed for IPO, I would have actually been planning for a tax regime where any further sale of that equity would not have attracted any tax. And now I'm stuck with a 10% tax. But that's a change in law that has occurred. For the purpose of the 31st January step-up, in the way the law is worded at this point in time, that step-up will not be available, because there is in any case no traded price available as of that date.
In the budget last year, the finance minister had taken away the long-term capital gains exemption for transactions that had not paid securities transaction tax. Subsequently, genuine transactions like court-approved acquisitions, ESOPs, were brought under the exemption net even if no STT was paid on them. Experts hope that the government may bring in a similar clarification this time around as well. With that, it's a wrap on this week's show. Do send us your feedback on Twitter, Facebook or email. Thanks so much for watching. We'll see you next week.